I do believe that we, 42 Macro, authored the resilient U.S. economy theme going back to August of last year, August of 2022. We have not pivoted from that theme. If anything, we've gotten incremental confirmation from our daily Bayesian research process that allows us to continue to, kind of pound the table that this economy's been resilient. It's going to lose resiliency in the months ahead, which we can unpack that. But now, we continue to see a lot of risk in the bond market associated with that resiliency of the economy and potentially an incremental move towards sticky inflation here in the U.S.
Welcome to Soar Financially, everybody. Thank you so much for joining us for another interesting discussion on the macro topics that are just shaping the world right now. My name is Kai Hoffmann. I'm the @JRMining guy on Twitter and the CEO of the Soar Financial Group. And in a few short seconds, Darius Dale will be joining us. He's the founder and CEO of 42 Macro, and they do macro risk management analysis. So I'm really curious because it sounds very German because it sounds like they're only looking at the risks. I'll ask him if there are some opportunities out there as well. But we're going to discuss some of the main topics that are sort of dictating headlines today. And that is GDP growth in the U.S. We're recording this on October 25th. So unfortunately, a day before the GDP number officially gets announced. But I saw the number this morning. I was like, that's a high forecast, 4.5%, depending on the source. I think Bloomberg has it at 4.5. Trading Economics looks at 4. So still a high number because we're coming from 2.1. I want to hear from Darius why that is, like what's driving growth. And we have the UAW strike, the strength of the US dollar. So lots to talk about. And we're still, I think, waiting for a recession. Let's see if that comes out. So before I switch over to my guest, hit that subscribe button somewhere down here. It's an oval shaped or something now. It's changed. It's down there. We really appreciate it because 80 to 85% of you watching are not subscribed. Let's change that. Now, Darius, welcome on the big stage. It's great to see you. Thank you so much for joining us.
Hi, it's a pleasure to be here. Thank you for inviting me. I just want to love the show, love the thought process, and I love my friends over in Germany, man. How you doing?
Awesome. No, thank you so much for making the time. First time on Soar Financially. Before I ask you the overall question, like how the economy is doing, I have to ask you, what do you do at 42 Macro?
Nail on the head with respect to macro risk management. I think there are a lot of the research providers out there that provide macro thoughts. We focus on the risk management of macro dynamics in the economy. And you mentioned one thing, in terms of, do we only think about it from the perspective of risk? Do we think about it from the perspective of opportunity? But I'd counter that and say that risk both directions. We think about risk holistically, both from the perspective of the right tail risk, i.e. the opportunities in financial markets, and left tail risk, i.e. some of the, the downside risk and the negative outcomes that we're trying to help investors protect. It's my primary job as a macro risk manager is to help our clients make and save money in financial markets on a consistent basis. And we do that through a variety of proven quantitative techniques that allow us to have a deeper understanding of what's happening in macro, and more importantly, what's happening in macro and how that's going to relate back to your portfolio. And I think that's kind of the missing link that we provide here at 42 Macro.
Fantastic. Awesome. No, thanks for the introduction. Just helps us set our mind a little bit and where you're coming from, obviously, as well, when we discuss the economy. Let us start there, Darius. Like, how are we doing right now? How is the economy doing? If I look at some of the economic indicators and numbers that are being published by the government, we should be in honky-dory land. Like, everything looks fantastic. Is it that?
I would argue it's a little bit too fantastic from the perspective of market risk right now. You mentioned we're going to get the Q3 GDP number tomorrow. The range is estimated somewhere between 3.5% to 4.5%. Could it surprise upside to 5%? Could it surprise the downside? Yes, we don't particularly care. GDP is not a particularly relevant statistic when you're trying to think about making and saving money in financial markets, but it will matter tomorrow for a few hours. So we definitely have to have that discussion. What I think is more important to understand is the sequential momentum of the drivers of GDP within the economy. Right now, we have a U.S. economy that is showing very, strong consumer demand. If you think about, look things like retail sales or real PCE, personal consumption expenditures, that's the broadest measure of consumer spending, roughly 70% of GDP. Those numbers through their most recently reported months are tracking at growth rates, 3-month annualized growth rates that are well above trend. Like, 200, 300 basis points well above trend. Now, we will slow in the months ahead for a variety of factors, which we can unpack. But the general, take is that consumer demand is growing well above trend. We have manufacturing and investment demand growing well above trend, as indicated by the most recent industrial production report and some of the GDP statistics that we got in the second quarter. And then ultimately, we have an inventory, a burgeoning potentially transitory positive inventory cycle that allows U.S. manufacturers to catch up with where goods demand has trended in recent months. And so you have this U.S. economy that has been extremely resilient relative to a consensus, at least a few months prior to go, that initially thought that recession was a high probability event in the first half of this year. I will be very frank in saying we were very not part of that consensus. And I will take it a step further and say I do believe that we, 42 Macro, authored the resilient U.S. economy theme going back to August of last year, August of 2022. We have not pivoted from that theme. If anything, we've gotten incremental confirmation from our daily Bayesian research process that allows us to continue to, kind of pound the table that this economy's been resilient. It's going to lose resiliency in the months ahead, which we can unpack that. But now, we continue to see a lot of risk in the bond market associated with that resiliency of the economy and potentially an incremental move towards sticky inflation here in the U.S.
Oh, fantastic. That was an amazing introduction there, Darius, and overview. While you were chatting, that's why I was a bit late to coming back on screen. I was just writing down that we need to talk about the resiliency of the economy, and then it's sort of crumbling away in future months. We'll talk about that in a second, because I want to drill down on consumer spending, because I'm trying to figure out where that demand is coming from, because the consumer seems to be getting hit with higher mortgage rates, student debt repayment kicking in again. Where is that demand coming from, and how are we financing it, or how is the consumer financing it?
Well, it's coming exactly where they told us it would come from if you pick up the most basic macroeconomics textbook that we have in college, which is income. Income growth has persistently and consistently grown well above trend. It continues to grow well above trend. For example, if you look at nominal employee compensation, which we get out of the PCE report, which I would argue is a far more important economic statistic to follow than GDP. The one we get on Friday, the day after GDP, contains a lot more information about where the leading edge of the economy is headed. But I digress. Going back to that, the PCE report, if you look at nominal employee compensation, we're still tracking at about 5 to 6% on a 3-month annualized rate of change basis through the most recent month. That number is well north of anything we saw prior to the pandemic. If you look at, the aggregated labor income out of the jobs report, which we're going to get next Friday, that number is still tracking somewhere north of around 4 or 5%, which again, a little bit north of where we were trending pre-COVID, but that's down from trending at rates that are closer to 7 or 8% in recent quarters. So this consumption demand that we continue to observe in the economy, this above trend consumption demand, has been primarily and overwhelmingly driven by consistent income gains for the economy. It's not, folks, I know folks are very keenly focused on things like rising delinquencies and rising credit card debt on a nominal basis, et cetera. And those things will eventually matter as we get deeper into the business cycle. But for now, those are more sideshows relative to these underlying and, in my opinion, very obvious drivers of the consumption cycle.
Fantastic. Interesting. Okay. Yeah. Very basic, actually, income growth. Because I remember walking into a Target store the other day in Dallas, and I think the minimum was $15 they offered. So
wow,
that was on the door.
Yeah.
So come join us, job opportunity starting at $15.
That's much higher than it used to be. I'll tell you that.
Yeah, exactly. Right. So that makes a whole lot of sense. Income growth, as you said, back to the basics. Right. One thing I wrote down as well, I might as well ask you here, because we talked about income growth, and is the UAW strike, the Union of the Auto Workers. One of my guests on the show a few weeks ago said, well, strikes happen at the peak of a cycle. Right?
Yes.
How do you factor that in, and how relevant is it? Because I remember coming back to the GDP discussion, Q2 GDP number was driven by auto sales, or by the auto industry, not just auto sales, but by the auto industry. So now that's disappearing, and there's a big strike happening. What's the economic impact is the short question.
Yeah, there will be some economic impact, but don't forget, we've already gotten September industrial production figures, and we accelerated to 5.2% on a 3-month annualized basis. That number is like 5x where we trended at prior to the pandemic. So clearly, I think it's very important. This is something I think we specialize in at 42 Macro. We specialize in a myriad of things, but one of the things that I think we do very well and very differently than other macroeconomic research providers is having this Bayesian overlay, this process of every time an important economic statistic comes out, whether it be retail sales, industrial production, inventories, GDP, all this stuff we are analyzing in rate of change format. and we're scoring them through the lens of, where they are relative to the trend, what's the delta in the time series, and ultimately what's the momentum, the rate of change of the time series. And this is for hundreds of data points come out per week. We analyze all hundreds of them, or each one of them, to understand, hey, how is the economy unfolding? We followed all that information to our nowcast models, and they've been quite accurate in helping us stay on the right side of right tail risk in the equity market and stay on the right side of left tail risk in the bond market, because we've ultimately understood that, hey, the economy is just consistently and persistently more resilient than the headline narratives out there. Things like, auto strikes and, the student loan repayment and all this other stuff that's sexy to talk about on Twitter and on podcasts. But the reality is that stuff is not really helping people make and save money in financial markets, in my opinion.
I love that you clarified that, because it is clickbaity, I have to admit, myself here. That's why I like asking those questions, because you usually get a good response out of people as well. It riles people up too, right? So that topic. And then they forget the basics.
About the basics.
Question that popped in my head that I didn't expect to ask, but how many indicators are you looking at, and has that number grown? Because it feels like, to me, it's endless out there. And depending on who I speak to, the indicator is very different they look at, right? So how many are you looking at, and has that number grown?
Yeah, so systematically, over the course of 1 month in the U.S. economy, we'll probably review about 60 to 70 indicators on the growth side. We'll probably review about 35, 40 indicators on the inflation side, and that's just for the U.S. economy. We run that same Bayesian research process across every major economy. We run sophisticated nowcast models to project the near-term momentum and growth and inflation across every major economy in the world, to get a general sense of how big dynamics like interest rates and currency and cross-asset volatility are likely to trend based on those forecasts. And so we're systematically analyzing everything. I don't have time to look at and write about everything as a human being, but what we do is look at and write about the things that matter most in terms of trying to help investors kind of, quote unquote, skate to where the puck is going to be in terms of where the news flow and the consensus narratives are going, how they're going to evolve in the coming months.
Do you have a favorite indicator, Darius, that you look at? No, there's something that
absolutely not. I have a favorite model of mine. We have our global macro risk matrix. So what that does, that system allows us to understand volatility and momentum across 42 what we consider to be the most important markets in the world. Whether it be, credit spread, high yield credit spreads, or, short-term overnight index swaps in the US or the Eurozone, whether it be, Brazilian equity. It's just 42 different markets in there across 12 different asset classes that combine to give us a real, true broad-based thought process around, hey, are we in a risk-off regime? Or are we in a risk-on regime? Are we moving incrementally risk off or incrementally risk on? And that obviously has important implications for investors' factor selection, for their position sizing, for their volatility expectations across asset classes, and that's been the most accurate model we built to date in terms of helping us stay on the right side of market risk.
I want to circle back what you mentioned earlier, is the sort of resiliency of the U.S. economy, but now sort of crumbling, leading into a recession. Can you lead us down that path? What is that going to look like? And maybe two-part question: what are some of the indicators you're looking at for that to predict that? And B, when do you expect the recession to sort of hit finally?
Yeah, great question, Kai. So I think it really starts with understanding, okay, what's really driving the business cycle forward? What's propelling the business cycle forward? And there's been a resiliency of demand in the labor market that's really continued to perpetuate the resiliency of income for consumers, and ultimately that virtuous cycle in terms of perpetuating the broader expansion of the economy. You have to understand, when is that resiliency in the labor market going to start to crack? To understand, hey, we're staring down the edge of something that looks like more of a material downturn in economics. We are going to slow from, roughly, let's say the number comes in 4% tomorrow in terms of Q3 GDP. We will slow fairly sharply from that in Q4. But whether or not we slow, that's the beginning of the end for the business cycle, remains to be seen. Because again, we continue to observe, a decent amount of excess demand for labor in the economy. We're running around, if you amalgamate, to total job openings plus the total amount of people who are employed, and then you subtract the total size of the labor force from that statistic, we're running at about 3 million in excess demand for humans in this current U.S. economy. And so until we can get that excess demand component down, either via, more than likely via job openings, because that's what's driving it down from its peak of around plus 6 million in Q1 of last year. If we can continue to see that, then ultimately we will see income growth slow, employment growth slow, and maybe that starts to become a reflexive cycle to the downside. We also have a couple other things that should weigh on growth, not just in Q4 in terms of the beginning of the new fiscal year here in the United States for the federal government, but should, very much slow growth on a year-over-year basis once we get into 2024. And that's some of the budget deficit dynamics. If you go back and you look at, the federal budget deficit, fiscal year to date, it's up around $300 to $400 billion relative to what it was year over year in the prior year, relative to what it was in the prior year. So we're talking about pumping around $300 to $400 billion into an economy that was already showing resiliency from the perspective of the labor market and the perspective of the consumer. We had a cost of living increase adjustment for things like Social Security and Medicare, which are roughly 40% of the federal budget. When you amalgamate all those different programs. We had a fairly sizable cost of living increase of 9%. That's unlikely to be repeated. It should be closer to somewhere that's closer to 3% looking into 2024. And then ultimately, we had the federal government change the tax brackets to account for the inflation that we observed last year. And so that ultimately resulted in a 20% increase in after-tax income in in disposable income for consumers relative to their 2022 tax basis. And so that'll all get reconciled in the taxes in April of next year. But it's one of those factors that have contributed to that resiliency that we've observed throughout 2023. So, when you stare into 2024, there's a lot of stuff on the fiscal policy front. There's things on the labor market front, particularly if we can't get productivity growth higher, because we're ultimately going to start to see that corporate margin pressure persist in a way that is not currently being forecasted by analysts and companies. If that persists, then we will start to see some degradation in the employment and the labor market outlook. But that remains to be seen. So it's not this rosy economy going forward 1, 2, 3 quarters. But for now, at least looking backwards 1, 2, 3, 4, 5 quarters, it has been quite resilient. And I think consensus just have to accept the fact that they've been wrong on that.
How does the U.S. election sort of factor into your models as well? Like, how predictable is it, and what kind of effects do you expect to see from it?
Well, we're in a fourth turning. I'm not sure if you're familiar with the concept of a fourth turning, but we are. It's going to be increasingly unpredictable as we move forward in time, and so trying to use something as inherently unpredictable as an election as an investment process, in my opinion, I think is flawed and potentially could lead you down to some negative outcomes in your portfolio. The one thing I will say is the number one I built hundreds of models in my career, some for our firm, some from our clients, et cetera, all across the world. And one thing I'll say is the model that I think has the best back test of all the models that I've built is the midterm election model. There is the back test on midterm elections of year 3 in an election cycle, i.e. the year when you observe the midterm election, you typically have this very, very high positive outcome relative to consensus expectations. I want to say the median return in a midterm election year is roughly about plus 14% with an interquartile range of something like close to 11 or 12, which is obviously that whole entire range is higher than almost double the kind of annual return you typically get in the stock market. So, we're all past the midterm election cycle. We are now in the actual election cycle. So there's really not much information to be gleaned from that particular model. So again, I think it's an important thing to talk about as a human being. There's obviously a lot going on in the world from a humanitarian crisis standpoint, geopolitical tension standpoint, and this stuff really does matter to us as people. But you got to put the blinders on if you want to talk about making and saving money consistently in financial markets. And unless this is something that's going to materially impact growth, materially impact inflation, materially impact policy, or materially impact correlations between assets that cause big institutions to change their portfolio construction, then it doesn't matter.
Interesting. Okay. Yeah, and a lot of people are not able to keep emotions out of their investment decisions. I'm blaming myself here as well. Like, I'm the first one to raise my hand is like, yeah, I get emotional because I look at the news, and Bloomberg is quite, what do you call it? Clickbaity as well, for lack of a better term. Like sensationalism.
They have some of the world's best AI designed to get you to click on those news stories. I mean, we're all victims of it. And look, this is why I think it's so important. If you've learned anything from watching this interview, viewer, it's to put the blinders on. Don't click on the headlines, click on the data. The data will set you free in terms of understanding what's actually going on in the economy, what's actually going on in financial markets. And analyzing data in a rigorous, systematic, Bayesian manner, i.e., I don't just pick and choose when I look at consumer spending or income growth. I analyze the data every single time it comes out to get the latest update. That's the difference between what systematic and institutional and good investors do relative to those that may, succumb to their emotions a lot more frequently, which is, I think, what a lot of investors do that are a little bit, on the shallower part of their learning journeys or their learning curve in this investment, game industry, whatever you want to call it. But it's obviously very hard.
Obviously, not everybody has an economics degree, right? So they need to follow the talking heads on mainstream media, be it the CNBCs, the Bloombergs, right? So
Agreed. Oh, actually, no, let me take that a step back.
Okay.
I don't know that I agree that they need to follow the talking heads, Kai. I think more importantly, they need to follow the data that the talking heads are talking about. When I listen to podcasts, when I listen to Bloomberg, when I listen to CNBC, when I listen to anyone speak about the economy or financial markets, I don't actually care what they're saying. I'm listening for the data that they're using to get to the conclusions that they're arriving. Hey, are they saying, hey, this is better or worse than it used to be? What is that particular data point? Do I have access to that data point? Obviously, if you're a retail investor, you don't have a background in econometrics or something like that, it's going to be harder to do anything with that data. But I think it's the most important thing you can do is to train your ears to listen for data, train your eyes to scan for numbers, as opposed to paying attention to everyone's investment theses. Formulate your own investment theses if you have access to data. And we've never had more access to data than we currently do right now as investors, as retail investors.
No, we just don't know what to do with it most of the times, right? So, and connecting the dots is another problem.
Typically want to be more bullish. If it's getting worse on the inflation side, you typically want to be more bearish. Policies tightening is typically bearish. Policy easing is typically bullish. And obviously, it's pretty straightforward. The hard part is piecing together the puzzle. And I do think you need professionals to piece together the puzzle for you. But I think at the end of the day, when you get yourself in trouble as an investor, when you start to piece together other people's puzzles with no foundational backing of what's actually going on, you're sort of, creating this meta-analysis on top of analysis with no real, kind of grounded understanding of what is going on in the economy, in the financial markets and policy, et cetera.
No, absolutely. Darius, I have two more bigger topics I want to tackle with you. One is, of course, the bond market. Bill Ackman this week made some waves saying he closed his bond short. Not sure how big his position was, but it was big enough for mainstream media to pick it up and talk about it. So I'm curious, how is the bond market doing? Because we're flooding the market, obviously, with new issuance, but also the yields are declining or rising again. They're at 5% roughly for the 10-year. How's the bond market doing? Where are things headed? What's your opinion?
I'll start by saying if Bill Ackman goes to the bathroom, it's going to be a story on CNBC. The guy's created a career out of becoming very popular in finance, and he's a great investor. Don't get me wrong; I've met him. He's a smart guy. Runs a very impressive firm with a lot of impressive people. That's not me. I didn't say that to be disparaging about Bill Ackman. I just said that to be disparaging about the traditional media, which is sort of very incestuous, if you will, about the talking heads that they put in front of us. But that's neither here nor there. In terms of the bond market, we still think there's left tail risk in the bond market relative to where we are in the business cycle. We don't necessarily believe that we are seeing the whites of the eyes on a recession to get investors excited about owning duration in the bond market. And don't forget, we're coming from a place where commercial banks, investors, insurance funds, hedge funds, everyone was very long duration, going back 2-3 years ago. And so it's not like a scenario where, hey, we've all been underrate duration, so let's just all go plow in and buy a bunch of duration with the expectation that growth and inflation are going to slow markedly in 2024. That's what you would be doing if investor consensus wasn't offsides already on the growth and inflation playbook that they put on the recession playbook that they put on at the beginning of the year. So that's neither here nor there. When I look at the bond market, there's a few things that we think are driving yields higher, both nominally and on a real basis. Clearly, the resiliency of the economy has been one of those contributing factors in terms of driving real interest rate expectations higher, and more importantly, out-year expectations of the Fed funds rate, whether you look at DEUTSCHE 24 or DEUTSCHE 25 or DEUTSCHE 26 Fed funds rate futures. That's been those have had a very high and tight correlation with the nominal and real 10-year Treasury yields, for the better part of the last year or so. And so, in our opinion, when two investors can start to look out into the future and say, no, the Fed funds rate in DEUTSCHE 26 won't be 4.75, it'll be 2.75. the only thing that's really going to get them excited about that is something that looks like a recession. So we're not there yet. We have a litany of leading indicators. We have our, we call our Fab 5 recession signaling indicators. We have a Hope Plus I framework in terms of analyzing all the different, data points in the economy that give us a sense of where we are in the business cycle. And then we have, just more obvious things like jobless claims, PMIs, that all tell us that we're nowhere near a recession. And so until we get some data that gives us an indication that we're near a recession, we're probably going to see an upward drift in bond yields to account for the fact that this is a Federal Reserve that is unlikely to be lowering interest rates on a systematic basis anytime soon. And that takes me to step number 2 with the bond market, which is the inflation dynamic. One thing that's currently being severely and grossly underreported, and I would love, Kai, for you to grab the flag and help me promote this, but inflation is becoming a problem again here in the U.S. economy. A lot of investors kind of analyze inflation on a year-over-year, analyze time series in general on a year-over-year rate of change basis. And that makes a lot of sense because that typically corresponds to how investors from a bottom-up standpoint think about company risk. But when you actually analyze the inflation data on a sequential basis, i.e. month over month, 3-month annualized, 6-month annualized, you're not focusing on the 3-month annualized rates of change, we are now starting to see a very, very obvious ubiquitous thrust higher in inflation. This is headline inflation, where you look at headline CPI accelerating about 5% 3-month annualized, core CPI accelerating about 3% 3-month annualized. When you look at measures of underlying inflation, like super core CPI, so that's core services, less housing, CPI, which is Jay Powell's called that out explicitly a few times in the past year or so. That number's accelerated to 4.7% 3-month annualized. These are numbers that are all 1 to 2 to even in some cases 300 basis points north of their pre-COVID trends. And so not only did we bottom in terms of the sequential impulse in inflation, we are now accelerating from levels that were higher than the prior mean. So not only, we didn't get back to levels that are consistent with 2% inflation, and we're now accelerating from those levels that we actually did get back to. So that's a real problem. We expect to see that continue. We're seeing, pick higher in energy inflation. If you look at the September CPI report, we had energy inflation accelerate to 29% 3-month annualized. That's going to start to drag the year-over-year time series higher in the coming months. But again, it's not a food and energy thing. I think it's the easy thing to look at as investors. And typically, inflation is going to track. The headline inflation is going to track the fluctuations in food and energy prices. But what's most concerning to me is that when you strip out everything that's, quote unquote, too volatile for the Fed to care about, we're actually still seeing a pretty significant thrust higher in inflation. Supercore, trim mean, CPI, median, PCE, et cetera. All these statistics are definitely moving in the wrong direction. And they very much have my alarm bell up as someone who's potentially could be investing in fixed income. We are currently not as an investor, because ultimately, in our opinion, the sticky inflation narrative is not priced in. No one's talking about it. They will be in a couple of months, in our opinion, if we continue to see the data evolve in the way that it has. And then this brings me to the final and third part that I want to make about the bond market, which are term premium. And so for those viewers who are not necessarily familiar with term premium and how they work, it's the excess return you get as an investor for locking in your risk over the course of, let's say a 10, 20, 30-year bond, as opposed to just consistently rolling over, whatever the implied short-term interest rate is for that particular duration. And so right now, we've seen a significant a rise in term premia from about minus 75 basis points, a few months ago to plus, roughly 25 basis points now. But that plus 25 basis points compares to a long-run average of around 150 basis points. Now, I'm not saying we have to go back to the long-run average of 150 basis points in this particular market cycle, but what scares the hell out of me is that why wouldn't we, right? You think about that long-run average of 150 basis points includes time series history that, from the 70s and 80s, early 80s of, plus 550, 400 basis points wide, and that was purely an inflation dynamic. But we're talking about longer term, a potential structural mismatch in the supply-demand dynamics in the Treasury market. You have the Fed currently selling. You have foreign central banks currently selling in terms of the foreign official sector. You have commercial banks currently selling and obviously sitting on a lot of treasuries that they don't want in their held to maturity portfolios. And so that leaves the onus on us, the private sector globally, to buy these assets to finance the U.S. government. And we know the U.S. government has $1.5 to $2 trillion budget deficits as far as the eye can see. So in my opinion, I don't think 25 basis points of positive term premium is the right number when you think about where we're headed from a fiscal policy standpoint long term. I don't know what the right number is, but I know that the long-term average is 150 basis points. And so in my opinion, I think you could easily see term premium continue to back up. If we get, some of the weirdness down in DC from a just geopolitical theater perspective. We can't even pick a House speaker. If we continue to see stuff like that drag the rating agencies into this, we will continue to see term premium back up in this particular business cycle. But again, I have no idea when we're going to peter out there.
Darius, I don't know how to put a bow around this conversation because I still have a gazillion topics I want to talk to you about, but I also know you have a hard cutoff, and I want to leave our listeners with some actionable, I would say, advice. Like, how do you see the year end? What is the Fed going to do next week? And how do we as retail investors sort of profit? Where are some of the opportunities right now? Looking at all the risks, of course, there have to be some opportunities out there as well. What are you looking at? And give away some of the secret sauce that you're sharing with your subscribers.
Yeah, so I'll start by saying 42 Macro, we run a systematic portfolio construction process. So in terms of how my assets and how many of our clients' assets are positioned, it's in a lot of cash currently, not because of Darius Dale said it should be in a lot of cash, but because of the dynamic position sizing components of that process have traded us out of a lot of instruments in the past 3 to 4 months, and have kind of systematically pushed us into a decent, a pretty high cash position. For the discretionary investors and traders among you, we do have a lot of products and tools that help investors, kind of understand where immediate term and near term market risk lie and opportunities lie, obviously. And one of those things that we see continue to pound the table on from a discretionary standpoint is getting long commodities, getting long gold, getting long Bitcoin, these things that obviously worked pretty substantially in recent weeks. So you may feel like you're chasing these things, but from the perspective of our process, there's really not a lot of other things that actually meet our criteria to put on a discretionary trade. In terms of our discretionary criteria, we're looking for assets that have developing positive momentum from the perspective of our volatility adjusted momentum signal. And that momentum, and this is on the long side, that momentum corresponds to how the assets to trade in the regime that we're currently in. We're currently in what we call an inflation regime. That means the market is pricing a trend lower in growth and a trend higher in inflation. That's typically risk off for both stocks and bonds, but there are a few assets like commodities, gold, Bitcoin that have historically kind of bucked the trend. Agricultural commodities being one of those particular the sectors in the commodity market alongside energy. So there's not a lot to do in an inflation regime other than raise cash. But if you're going to be investing in an inflation regime on the long side, clearly those are going to be your target exposures. On the short side, there's a ton to do in an inflation regime. Right now, we have the bearish signals from the perspective of our volatility adjusted momentum signal across U.S. global equities, the muni equity sectors and factors. When you look at the fixed income space, all the spread products in fixed income like investment grade credit, leveraged loans, things of that nature, all that stuff's bearish from the perspective of volatility adjusted momentum signal. And more importantly, it's supposed to be bearish in the inflation regime. So we have a lot of short signals on right now that are currently being risk managed through some of these systematic processes. So I highly invite investors to come check out our discretionary investment summary and discretionary investment ideas summary to the extent that they want to learn more and kind of follow the evolution of that, because it's obviously helping a lot of investors worldwide kind of manage risk.
Fantastic. Darius, I tremendously enjoyed the conversation because I had to Google left tail and right tail, to be honest. Like, I'm not an economist, so I fully admit that. But you brought a lot of fresh perspective to the channel here, so I really appreciate that. Where can we find more of you and your work?
I appreciate you, Kai, man. Thanks again for having me on. I love just the opportunity to educate. I kind of spent my entire career on Wall Street, like this, institutional, fly around the world, meeting with asset managers, talking about very sophisticated investment processes and procedures. And in this new life of mine, as the guy in the blue shirt at 42 Macro, what I'm trying to do is level the playing field between all those folks that I fly around the world to meet with and our retail investor clients. And, so in my opinion, I don't think that this information needs to be kind of harbored or there needs to be a moat around this information for just the sophisticated people and the rich people on Wall Street to benefit from. I think every human being in the world, including our friends over in Germany, deserve to benefit from this kind of high caliber information as well. So definitely come check us out if this kind of information is relevant to you. I said that, we typically skew sophisticated in terms of our retail investor audience, but we do make sure we have a lot of educational components of our process. We do teach a lot as well at 42 Macro. So come check us out, 42macro.com. If it's a little over your head as an investor, I highly recommend just following me on Twitter. My Twitter handle is Darius Dale 42. We put out a lot of educational material on a daily basis there as well.
Fantastic. Darius, again, tremendously enjoyed the conversation and hope to have you back because we haven't talked about the US dollar, liquidity. What else did I write down? The earnings season. I really wanted to talk about that, but I couldn't fit that one in. Like, what are some of the indicators you're looking at there in the earnings reports? way too much for just a 30-minute conversation. We'll have to get you back. Thank you so much for your time, and everybody else, thank you so much for tuning in. We hope you found this conversation insightful. Darius definitely kept me on my toes. I Googled a few things because I think The Fourth Turning is a new book that's out by Neil Howe as well that just came out recently in an updated version. So check that out as well. I should probably put a link below as well to that. And it's not going to be an affiliate link. I don't care. But so subscribe to the channel. If that was all too fast for you, I'll probably have to rewatch this conversation in half or three-quarter speed as well, because Darius must have been probably a floor trader in the past as well, because he talks very fast. I talk fast, and if somebody else talks fast, I speed up as well. So slow down the video. YouTube gives you that option. If you haven't done so, of course, smash that subscribe button, leave a comment, leave a like. Where do you see things are headed? Sticky inflation is a topic we have sort of discussed on this channel before, but what do you think? What are you seeing in the markets right now? Because I think sticky inflation, especially like one of our guests sort of said, okay, we'll have sort of cycles of inflation, and I think we're just at the bottom of one and just about to spike up again. That's my opinion. Really curious to see where things are headed. Thank you so much for joining us. I've said enough. Let's go. We'll be back soon.